Hey everyone, so thank you so much for joining us today. Very thankful to each and every one of you who have actually taken the time out to join us before the festivities begin over the weekend. Right, so my name is Melvin. I'm a senior wealth advisor here, and some of you might have spoken to me before. But joining me is also Ritesh. He is, of course, head of investment advisory here at Syfe, right? So a little introduction about us here at Syfe for those who are joining us for the first time. We are a digital wealth management platform, right? With a mission to, of course, empower people and users to build their wealth for a better future through revolutionary wealth management experience so that people can grow their money to its fullest potential all within one destination, right? But of course, all of it starts with trust in order to become a trusted and reliable partner for your investment funds. First and foremost, we secured a retail fund management license, also known as a capital market service license, right? There are stringent requirements, and we do fulfill all audit requirements of us, pass them with flying colors. One of the key requirements is also the use of a trust account for your deposits. When assets are purchased, such as the shares or securities, they are held via our broker, custodian, which is Saxo Capital Markets, whose sub-custodian is, of course, HSBC and Citibank. This actually assures that there is no commingling of funds with ours, as much as we have learned from the recent debacle with FTX, right? So a little bit of our prouder moments. We actually launched back in 2019 in July here in Singapore. And in about a year's time, we actually raised our first Series A of about $18.6 million. And almost a year later again, Series B funding of about $30 million, right? This actually allows us to actually launch in Hong Kong and also in Australia in almost like a 3 months quick fire succession. We also won Wealth Management of the Year and also LinkedIn Top Startups and also Future of Digital Infrastructure, all within October of 2022. Right, so a little bit on 2022 investment behaviors. It's a good chance for all of you investors to actually see how you match up against those that we survey and also your fellow peers investing with the platform or off the platform. Right, so Syfe investors remain confident to invest. This, as you can see, compared to non-Syfe investors, right? They are also calm and also less concerned compared to non-Syfe investors. And of course, Singaporeans do seek higher, more stable returns. This is where we actually did a quick search of Google Analytics. Average monthly searches of fixed deposit, SSB and T-bills skyrocketed in the second half of 2022 as the financial markets kind of destabilized a little bit in that period of time. And of course, a cash overload scenario, right? 4 in 10 investors surveyed have more than 6 months of monthly income saved in cash, right? This is actually much higher than the typical recommended amount of about 3 to 6 months of living expenses. But this is also due to the financial markets being worse off. Job security in certain sectors are not as safe as before as well. So we do understand that investors in this period of time, they do prefer the safety and reliability of cash, right? And of those surveyed, most actually believe that their financial goals will be delayed due to rising costs and uncertainty, right? Only 9.9% is confident and on track, right? And if you can see the bulk of it, 40.4% is confident that they are slowed, right? Now, for custom and thematic portfolios, right? An average custom portfolio has about 4.2 ETFs in it. Despite a difficult year, the most popular ETFs are those with exposure to semiconductor, lithium, and battery industries, right? ETFs which track the US stock market also continue to be highly sought after, right? But when it comes to thematic portfolios, right, ESG remains the most popular. ESG stands for environmental, social governance. It is the most popular. It ages out the other teams with the number of portfolios doubling, right? Our next most popular one is, of course, disruptive tech. And those who have been using disruptive tech might have been following the recent financial markets as well. Tech has taken quite a big hit. And then, of course, if you see healthcare, followed by China growth and global income, right? There is appetite for satellites, but more so for ESG, right? There are changing investor behavior and also knowledge of the sector. We have to invest perhaps more sustainably to assure ourselves of a better future in terms of for our children, and to, of course, set a better example ahead. Right, so most popular trades last year, right? So between US, right, you can see that the most popular trading stock is Tesla, followed by Apple, Amazon, Alphabet, and Grab, right? For Singaporean stocks, however, Sheng Siong, right, Singapore Airlines, CapitaLand Integrated Commercial Trust, Singtel, and Sembcorp. Now, trade versus wealth behaviors. We actually obtained several insights on how our investors are maintaining their focus on staying invested for the longer term on wealth, whilst being adapting to like shorter term portfolio strategies through trade. Right. So what's consistent across both platforms is that low cost ETFs top both charts, right? Be it on wealth or trade, as we can see, like QQQ, VOO, S&P 500 derivatives, like the CSPX, which is the London more tax favorable one, right? And then QQQ followed by lithium, lit semiconductors, VOO as well, right? So very similar in terms of preference for low cost index funds. Now, I will pass it on to Ritesh for the macro outlook and trends ahead. Nope, Ritesh, I'll mute.
Sorry. Hey, thanks, Melvin, for covering, I think, very interesting behaviors and trends that we saw for last year. And I think in general, if you put it all together, of course, rising inflation, the Federal Reserve policy, compounded with sort of geopolitical risks, the Russia-Ukraine war related to that, again, energy prices and other such implications, commodity prices going up, plus the whole debacle about China, right? Like what's going to happen there, the COVID-related curbs, the regulatory overhang, as well as when is the reopening going to take place. All of these were kind of top on mind for investors over the last year. And in terms of global markets, it was a difficult year, right? So 2022, all major global indices, they did suffer one of their worst performances since 2008. And kind of like ending a 3-year winning streak. So much so that if you look at some of the biggest indices that people follow, for example, S&P 500, that dropped by close to 20%. It entered officially into a bear market territory, which is, again, at 20% level. More of the growth investors and the growth indices related to that, which is say NASDAQ, fell by over 30%. So NASDAQ was down close to 33% for the full last year, right? So overall, I guess like it was obviously very challenging. And to that extent, as Melvin, you shared, a lot of investors looked for safe haven assets and places where they can park their money. And given that Federal Reserve was increasing interest rates, the value of keeping money into savings accounts, or in Singapore, for example, savings bonds, T-bills, our own cash management solution, we saw a good amount of inflow because people looked at these safe haven assets to make sure that their capital is protected, right? And they did not want to incur more losses. So coming into 2023, obviously, we are looking at a scenario where the first couple of weeks of January look a lot more optimistic compared to what happened in 2022. The US stocks have experienced a decent amount of rally, mainly following release of some important indicators such as employment data and inflation data as well. So let's take a quick peek into all the data points that have come and the Fed policy related to that, right? If you see this chart, it kind of maps out what is the terminal federal interest rate projected over the course of 2023. In terms of how the Federal Reserve is thinking, obviously a few things that Fed watches very closely is inflation as well as employment. On the inflation front, the headline inflation rate, or the CPI in the US, has slowed for a sixth straight month to 6.5%. So that's the latest print, 6.5%, as of December 2022. This is the annualized kind of growth rate, and it is the lowest since 2021 October. And this was in line with market forecasts, right? And this follows a 7.1% increment that we saw in November. So, progressively coming down a bit. On a monthly basis, the CPI number is also flattened, right? So previously, every month there is slight increases versus in, coming into December, the CPI numbers have flattened from a month-to-month perspective. So over the last 4 years before this thing, the CPI rates used to increase by 0.1%. This December, it has kind of flattened out. This also means, hopefully, there is kind of market optimism that this should lead to a pause in the Federal Reserve rate hike over the course of this year, and potentially rate cuts coming into the end of the year. But we also saw the Federal Reserve's meeting minutes from the December 13th and 14th policy meeting that was released, somewhere around last week. The meeting kind of summary, if you were to look at the exact statements, one of the statements was basically participants generally observed that a restrictive policy stance would need to be maintained until the incoming data provided confidence that inflation was on a sustained downward path to 2%, which was likely to take some time. So in a sense, this meeting kind of reaffirmed the Federal Reserve's stance of continuing to control the cost of credit or interest rates in order to also control, the related inflationary pressures. And I think the main concern that the policymakers have is the pace of price increases are expected to run faster than anticipated, right? So they're still not sure if this inflation number that are coming out is going to sustain over time. And while it is coming down, will it trend down towards their 2% target is still a bit far off, right? We're still looking at 6.5% annualized growth rate in terms of the inflation. So in general, the minutes of FMC members basically expect no rate cuts in 2023, right? If you read between the lines, they don't expect, but the broader markets do expect that there will be some rate cuts happening towards the second half of this year. So if you move on to the next slide, obviously this kind of brings us to the point of recession, right? If the Federal Reserve continues to have kind of a hawkish stance, then the odds of recession over the next 12 months, this is numbers that we have been able to extract, have obviously increased to 65%. So this is the average consensus of a recession happening in the next 12 months. And the odds of those recession post the release of these Fed meeting minutes have increased to 65%. However, if you look at Goldman Sachs and their forecast, their analysts project a much lower risk of recession at 35%, and with the hopes of a much softer landing. So in general, I think while the broader consensus is still, high in terms of inflation, there are parts of the market segment that do believe that the inflation numbers can be controlled. The Federal Reserve will be able to, do a softer landing, alongside some other leading factors such as, the labor market, which continues to remain still strong. So while we keep listening and keep hearing about all the layoffs happening, kind of left, right, and center, but the broader, labor market still looks very much in flux, and the unemployment numbers are still below 4%. So even though I guess the probability of recession has increased a bit, albeit I would argue that it looks still, mild. Hopefully, whatever the recession happens, we'll be able to, or the Fed will be able to engineer a soft landing. The broader economy looks still in good momentum, and looks like, we are in decent control in terms of how, the markets will pan out over the course of the rest of the year. If you were to ask me my personal opinion, I believe that over the next few months, the markets will continue to be volatile as, they digest how the Fed pivots between the federal rate hikes. But towards the second half, we should expect a little bit of a thaw in terms of Fed reaching its target terminal interest rates, and then whether there is a rate cut happening this year or not. Generally, markets are a little bit more forward-looking, and to that extent, we should anticipate that the markets should have a greater positive momentum towards the second half of this year. All right, so that brings us to the question of, what do we do, right? Like, as investors, where should we be investing? What should we be doing with our portfolios? In terms of key themes that are emerging, one of them is the return of the 60-40 portfolio. Of course, last year, it was just atrocious, right? Like, basically fixed income fell, equity fell, REITs fell. Almost all asset classes kind of fell in tandem, and the traditional setup where bonds and equities are oppositely correlated no longer held, meaning that people who had conservative portfolios or moderately allocated portfolios suffered similar drawdowns to an all equity portfolio, right? Which was a bit hard to digest for an average investor, and called into question whether the 60-40 portfolio is relevant anymore, right? Like, 60-40 has been kind of the bedrock of investing for multiple decades, but this period of 2022 really called it into question. But I guess, like, if you look forward, the falling markets have brought some sort of a silver lining. The government bond yields and credit spreads have increased sharply. Also, equity valuation multiples are now at or below average levels seen over very long periods. So the combination of these rising bond yields and the falling equity valuations basically mean that the expected returns from multi-asset portfolios have moved considerably higher, right? Like, if you see this particular chart, the expected returns have moved back high, wherein essentially if you have a 60-40 portfolio right now, the nominal expected return is 7.2% versus it used to be, like, say, 3.3% in 2021 when the valuations and everything looked very high. So definitely in terms of forward-looking returns, you could look at a scenario where you don't really need to take too much risk in terms of equity exposure, and even a balanced portfolio should be able to give you a decent amount of nominal level of returns. All right, next slide, please. So also, I think on top of that, it is important to understand that, while 60-40 is definitely here to stay, and folks who invest in the conventional sense should expect a greater kind of nominal returns coming into 2023 and beyond. It does help for us to diversify into more asset classes, right? So while 60-40 can be used as a foundation for your portfolio, the continued inflationary kind of an environment still poses challenges in different ways. So if you can expand your investments into asset classes, and these asset classes which are a little bit alternative to your traditional equity bond portfolio, such as commodities, REITs, international and emerging markets, these, in addition to bonds, can help you diversify further, as well as reduce volatility and increase your expected returns. So definitely worth considering, like, if you are investing into either like an all equity portfolio or a traditional equity bond portfolio, we do advocate like a core satellite investment strategy, which means that bulk of your money should be invested in a passive manner across the traditional kind of asset classes. But I think it helps in the current environment to diversify further into these return enhancing asset classes as well. All right, so next slide, China reopening. Yes, so I think this is a very important aspect. I think a lot of investors who were loaded onto China, or if you had outsized allocations to China, the last 2 years were definitely very, very painful, right? A lot of the key indices tracking the China markets were down anywhere close to like 50-60%, if not more. And a lot of investors have lost patience in terms of investing into China. But coming into the fourth quarter of 2022 and the first few weeks of 2023 as well, the investor sentiment on China has also turned bullish in the last few months, right? If you look at some of the key indices, such as MSCI ETF, which tracks the MSCI China index, it has risen by over 32%. KWEB, which is basically your internet index, has jumped by over 48% just in November of 2022. This chart that you're seeing basically shows that over just like the last few months, the overall China market is up by more than 50%. Now, of course, there is still a long way to go for investors to get back to parity when it comes to investing. If you would have invested, say, early 2021 and beyond. So, there is still a lot of room to go, but definitely looks a lot of, there is a lot of positivity coming in from China. And generally, I think the rally has been sparked with the hopes of a faster exit from the zero COVID policy, as well as, the Chinese government's recent positive property market measures as well. So hopefully, this marks to be like a turn on the corner, given that there has been a very strong underperformance of Chinese equities throughout 2020, 22 mainly, 2021, mid 2021 through 2022, and kind of was led by frequent lockdowns, property sector related issues, regulatory overhang, and even like, monetary policy and related decision makings. So looks like we are on a positive trajectory coming into China, and hopefully, 2023 should be the year where, in your investments into China should lead you to much better, outcomes in terms of returns, and as well as hopefully some outperformance against traditional indices. Overall, though, I think while these are key themes that are emerging, if you look at your broader investment, investment portfolio, I think one thing that we always emphasize is to remain patient and remain invested, right? There is no point kind of trying to time the market. And one of our key sayings is, it is really the time in the market rather than timing the market that determines whether you accumulate wealth in the long term through your investments into the financial markets. So essentially, if you were to look at the financial markets over longer periods of history, and I'm talking about centuries, right? There have been multiple bear markets or more than 20% declines in the stock market, and usually averaging once in every 3.5 years. So every 3.5 years, usually there'll be a 20% plus correction. But the good news is, after each of these corrections, the market eventually does recover and then goes on to make new highs, right? If you look at this particular chart, you will see that despite some of the downturns through your investments over multiple sort of decades, some of these downturns were quite long and severe. You can see that a $1 invested at the end of, back 150 years plus, right, 1870, grows to $20,500 in real terms in 2022. And this is a real annualized rate of return of close to 7%. If you look at more recently, right, if you invested into S&P 500 at the peak of the market in, say, 2008, before the global financial crisis, right? So you came at the top, probably the worst timing ever, right? Top of 2008. And then you went through the COVID crisis in 2020, and then the bear market run last year. So basically going through 3 crisis situations. Even that, if you stretch your investment time horizon from 2008 all the way to the end of 2022, you will still be ending up with a nominal return of over 250% on a cumulative basis and 8.8% on a more annualized basis. So I think the lesson here is really about investing for your long term, right? If you're investing for your long term, say retirement or other such needs, it is really, really important to invest in a unbiased manner, in emotionless manner, and as well, because it is incredibly hard to time the market. But if you just remain invested and are able to go through these ups and downs of the market, then you should be able to make money over the long term, right? So obviously we as well, right now, sitting here as experts, still do not have a crystal ball into the future, right? But what does the history tell us? It tells us that building wealth successfully is not the ability for you to sort of predict whether this is the low of the market or this is the high of the market, whether we are dawning on a new lost decade of investing, but the ability for us to remain consistent with our investment strategy. And stock markets have been very generous to investors who can get through such periods of market decline and invest for the long term. So definitely, I think as a closing thought in terms of how you should be thinking about your investments moving forward into 2023 and beyond, some of the ideas that we have shared hopefully should be things that you could consider as part of your investment strategy, but definitely have bulk of your money invested in a passive manner for your long term and remain consistent. I think that itself should do a very good job of helping you accumulate wealth through time. All right, with that, I think we should take a quick break and see if there are any questions. I don't see any questions yet, so maybe we continue, but everyone who has joined in today, please feel free to raise any questions that you might have, and happy to take them forward. All right, so with that, let's move to the Syfe portfolios, a quick review of our portfolios and performance for 2022. Melvin, if you can move on to the next slide. All right, so obviously, I think over the course of the last 3.5 years, and Melvin shared our journey with all of you since the time we've launched. You can see that now there's a full suite of investments for your different kind of needs and stretches from a core portfolio that helps you diversify and invest globally into equity, bond, gold kind of components. You can invest in specific themes to kind of follow mega trends such as disruptive technology, healthcare innovation, specific sectors such as, say, ESG, clean energy, specific countries, say China growth. So there are all these specific themes that you could follow. Obviously, in Singapore, people love generating yield and dividend-based products. So our REIT Plus portfolio continues to be one of the most popular strategies that people are investing into. Currently, I think the dividend yield from the REITs portfolio is also very, very attractive. So these definitely could form, kind of core building blocks. So the core portfolio is where we expect a lot of people to invest for their long-term needs of, say, retirement, children's education, and other such goals. Thematics are more for you to express yourself and take active sort of views on different segments of the market. REIT Plus for you to generate some sort of a dividend income. Of course, Cash Plus, as I had shared earlier, if you're looking for a kind of a safe haven with yields that are flexible over time and it increases as interest rates increase as well. Our cash management solution right now is yielding projected return of 3%. And hopefully it should continue to move higher as we move towards the first and second quarters of 2023 as well. Of course, if you want to build your own portfolio, we have our custom portfolio builders, so you can custom build whatever allocations that you deem comfortable with, and you're able to edit the portfolio and change allocations as you want without incurring any brokerage fees and all as well. On top of that, we have our trade platform. So the idea is whether you want a fully managed solution, you want to self-create your own portfolio, or you want to DIY into individual securities. Now you're able to do it through a one-stop kind of a solution through the Syfe platform of Syfe Wealth and Syfe Trade. And we give access on the trade side to both the US and the local Singapore market. All right, so with that, let's quickly cover the actual performance of our core portfolios for 2022. So if you see, I think it's a bit small, but hopefully you can see the 2023 returns for our core portfolios and also the benchmarks against which we track these portfolios to. In general, our Equity 100 portfolio, also the most popular portfolio on our platform when it comes to the different core portfolio options, outperformed MSCI World by close to 1%, right? Obviously, the markets themselves were negative. So the portfolio was also double-digit negative for last year. but outperformed MSCI World by close to 1% for 2022. The other portfolios, if you look at the core growth and core balanced, these two portfolios had longer, fixed income, longer duration fixed income components, which led to some underperformance in these portfolios compared to their respective benchmarks. And then the defensive portfolio, which almost was in line with its respective benchmark as well. In terms of looking forward, what you can see is the portfolios across the board have started outperforming, right? And there are obviously reasons behind it in terms of why this is happening, right? 2022, our equity portfolio outperformed as it was well diversified across, geography sectors, as well as asset classes. But in 2023, one of the key factors that has led to the outperformance of equity 100 and the equity components in other core portfolio is, a slightly higher allocation that we maintain to China. And China, as I shared earlier, has risen by over 50% in the last few months. So that's really one of the key contributors to the outperformance of our portfolios coming into the first few weeks of 2023. Similarly, the growth balanced portfolios, which did have some underperformance in 2022, are now recovering and outperforming their respective benchmarks, because the longer duration embedded into these portfolios and their fixed income allocation are now yielding much higher returns. And there is also some upside that they are capturing as we reach peak, interest rates in the market. So our view is basically, as we move on to 2023, our mixed allocation portfolios should continue doing very well as we reach peak interest rates in the US, as well as our equity 100 and the equity components within the other core portfolios should also continue to do well if our thesis on China stands, and the fact that the reopening leads to economic recovery there as well. All right, quickly reviewing our thematic portfolios and their performances as well. Generally, it was a bit of a mixed bag for thematic portfolios for 2022. Obviously, if you look at the more disruptive sectors of the markets, such as disruptive technology and related stocks, which are very, very high growth, typically this portfolio invests into companies which might not be profitable. They might have a very large market to capture, or they're, investing into certain segments of the market which will evolve over time and will create a huge marketplace over time. And a lot of these companies' valuations got stretched through 2020 and 21 through the COVID kind of monetary easing policies. And coming into 2022, with the Fed tightening and the interest rates rising, this led to a much needed, I would say, correction into the valuations of these companies, right? Because again, then the fundamentals came into play. When you're valuing companies, typically the interest rates are used as discount factors. So the present value of these companies, compounded with the fact that the revenue of these companies were not at a state where the valuations could be justified, it led to pretty hard correction of 40+% compared to the broader market, which was down around 20-odd%. But if you look at the other segments such as ESG and clean energy, as well as healthcare innovation, these two portfolios, even though fully equity, were roughly in line or outperformed the broader markets, right? So if S&P 500 or MSCI World was down 18 to 19% last year, these portfolios were down around 17%. Similarly, China growth kind of suffered through the first 3 quarters of 2022. It at one point was down close to, I think, 35+%. But again, in Q4, as well as the first few weeks in January, the China growth portfolio has also staged pretty impressive gains. And if things continue in kind of the momentum that we are seeing there, hopefully you should see more positivity coming into the Chinese equity markets as we move forward as well. Similarly, our global income portfolio was down around 12.5%. And of course, negative, though lower risk. But in terms of comparison, if you compare it against a global aggregate bond index, it outperformed that index by over 4%. All right, so we move on to the next segment, the REITs portfolio. Melvin. Cool. All right. Yes. So in terms of the REIT portfolio performance, 2022, we ended with the 100% REIT portfolio down 9.8%, and the risk managed REIT portfolio down 8.72%. Overall, if you compare this against the global equity markets, the backdrop there with the broader indices falling close to 20%, this is definitely one place where investors did find some respite. Obviously, still pinching because the overall return is still negative, but the portfolio was doing, by August, I think it was flat for the year, but I think since the Federal Reserve continued tightening through September, October, it ultimately gave up around, close to 10% for the year. But if you look at it from another angle, this also led to the dividend yield from the REITs portfolio increased quite a bit, because as the price corrected, the yield on the portfolio increased quite massively. 2022 ended close to 5.1%. But if you look at the current yield from the 100% REIT portfolio, it is as much as 6%. So, investors can look forward to an enhanced yield in the current environment. And hopefully, as the market turns, I think the local Singapore economy and the market forecast is a lot more positive, and there is a lot of inflow in terms of businesses, capital, as well as people in Singapore, and that should sort of lead to positive outcomes, hopefully, for the REIT sector as we move forward. Closing it with the cash plus portfolio review as well. As you can see, the cash plus portfolio was yielding close to, or it was yielding to 1.2% when we started the year in 2022, when the interest rates were really, really low. But coming into the end of 2022, we ended the year with a projected return of 3%, right? So the projected return kept on increasing as the Federal Reserve increased its interest rate throughout the year. And another important point to highlight is the fact that while we revised our projected annual returns, the actual returns from the portfolios tracked very much the projections that we had put in. So investors who invested into these portfolios were able to realize returns which were very close or even better than the projected returns that we had put in for these respective portfolios and for the relevant periods when we had updated these projected returns. And this is against a backdrop where essentially we have constructed our cash plus portfolio with a view that it needs to be stable. It needs to be a place where investors can, relatively be, think of it as a safe haven asset and can park their capital without having to worry about too many mark-to-market risks. And that really kind of shows up in the chart above as well, because, the Syfe cash plus portfolio continued to have a very steady, consistent growth throughout 2022. This chart is not fully updated to the end of the year, but story doesn't change massively even if you stretch it till 2022 end December, because our portfolio remained consistent versus I think there are certain cash management solutions available in the market which do project a much higher return. But the fact is that, it's not possible for you to generate excessive returns without taking extra risks. So the extra risks kind of embedded within these portfolios led to, mark-to-market corrections. And that was really unnerving for clients, because you're losing money on your investment portfolios and you want to park your money into cash to kind of guard yourself against drawdowns and MTM losses. But you park your money into these kind of portfolios and then you lose money there as well. So I think there is a big lesson here to be learned as well, that not all cash plus and cash management solutions are built the same way. So please do your due diligence when you're choosing a cash management solution. Look beyond the projected highlighted yields, look underneath and see what are these cash management solutions investing into. And that will tell you whether you should be able to generate a consistent yield without having to kind of lose sleep over, kind of having some losses even in your cash. investments. All right, I think that's mostly things that we wanted to cover in today's session. Let us quickly take a look at some of the questions that we have. So it looks like there is a couple of questions coming in from Tarun. Tarun, thanks for the question. Let me look at the first one first. What is the risk quotient while investing in cash management account for parking spare cash but maintaining liquidity for potential immediate use? Sure. So Tarun, great question. And this is what I was kind of highlighting with our cash plus portfolio. Typically, cash management solutions are built using money market funds. And money market funds invest into a range of products. Typically, these products tend to be deposits with financial institutions, bonds with government or quasi-government organizations, or very high quality investment grade kind of corporates. One of the key features of these underlying bonds and instruments that these money market funds are investing into is the fact that the duration or the average maturity of the underlying instruments are kept very, very low. Typically not more than 3 to 6 months. And because of that, the probability of any of the underlying instruments to default, because number one, the quality of them is really high, plus the fact that they're maturing in quick succession, means that usually when you're investing into these instruments, you should not expect a lot of mark-to-market movement. Plus the fact that they are wrapped around in a fund kind of a structure, you're able to get liquidity and you don't need to lock up your capital. So when you invest into fixed deposits or other such instruments, your money get locked up, versus in a cash management solution, your money is liquid all the time and you can take it out for your different expenses and needs as well. Typically in our cash plus product, we have not seen any negative week for the product. And as you can see from the chart as well, it's relatively very, very consistent, straight line kind of a return profile. And that's the kind of experience that we want our customers to have, that you should have confidence that the money that you park will, grow in a consistent manner. And you're able to liquidate it for any emergency use case or any, upcoming expenses and all as well. So I think typically if you have 3 to 6 months where you have an upcoming big expense coming up, definitely a great place or a great potential place for you to park your money, and with relatively very, very low risk. In terms of the second question, I think Tarun, one more, with the US dollar continues to stay strong, what is the potential forex risk when investing in SGD? All right, great. I think a good question. In terms of the US dollar, what I would say is, while the US dollar was pretty strong last year, coming into, again, the second half of 2022 and 2023 as well, the US dollar has started weakening against Sing dollar. And that is, I think, a little bit self-explanatory, because usually the US dollar strengthens as the interest rates start to go up. But as you reach kind of the peak in interest rates, and the markets are always kind of forward pricing. So with the view that essentially the Fed will pause the rate hike somewhere in the middle of 2023, and then there could be some rate cuts, you're seeing that the US dollar strength is coming off and Sing dollar is appreciating, to the extent that I think now we are looking at 1.34 versus the US dollar, and used to be 1.45 not too long ago. So in terms of if you're asking about views going forward, I think I don't anticipate the US dollar strengthening too much. In fact, there could be more depreciation of US dollar as we move forward. All right, the next one is from Vijay. Will equity 100 be changed to better adjust to the current market, since the tech and big cap stocks are faring worse now compared to others? So great question, Vijay. So what we have already done, essentially we rebalance our equity 100 portfolio 2 times a year, in March and in October. The last rebalance that we did, or the last couple of rebalances that we did through March and October, we have ensured that we have a healthy mix of the higher growth sectors such as technology, but at the same time, we also have exposure to the value sectors, right? So if you were to look at the composition of our equity 100 portfolio, you will notice that there is an allocation to QQQ that captures more of the growth elements of the market, but there is also an allocation to RSP, which is an equal weight to S&P 500. So in a way, captures a little bit of value within the market as well. On top of that, we also embed defensive sectors as part of the portfolio construction. So that is usually done to kind of reduce the overall volatility of the portfolio. So you have things like utility, consumer staples, healthcare, these kind of sectors that are having specific exposures in our equity 100 portfolio. And usually, in a way, having like a kind of a barbell strategy where you kind of don't miss out on the potential recovery of the growth sectors such as technology, but also capture some of the outperformances that you're seeing with value sectors and some of these defensive plays as well. We also, if you look at our equity portfolio, we have a higher allocation to China compared to traditional market indices. So if you look at MSCI World, typically the China exposure is around 4% versus equity 100 has an allocation close to 15 to 20% in that range to China. Obviously a bit higher than the index, but it kind of captures the economic contribution of China to the global economy. And while the China allocation did lead to some detraction in our performance last year, but overall the equity 100 portfolio still outperformed the broader index. And coming into 2023, if I can go back to that slide, Melvin, the core portfolio, the first few weeks in January, you're seeing close to 1% outperformance within 3 weeks of 2023, and all the portfolios are positive, looking decent at this point of time is what I would say. Cool. Let's move over to the next few questions. I think some really good questions coming in. How does the Syfe Wealth offering differ from unit trust, or is it essentially the same? Great question. So number one, most of the portfolios that we construct, we use ETFs as building blocks. We don't use unit trusts. So the core portfolios that you're looking here are built using ETFs. And our belief is when it comes to the broader global market investing across asset classes, sectors, and all, it makes a lot of sense to build your core portfolio using ETFs, but because they're just a lot more efficient, they're a lot more cost effective. A typical ETF in our portfolio, the average expense ratio of the ETFs underneath these core portfolios is between 0.15% to 0.25%, versus when you invest into unit trusts, typically the annual management fee from the unit trust itself is 1.5% to 2%, right? And then on top of that, if you're buying them through banks and all, you will end up paying sales charges and other such costs and all as well, and potentially some wrap fee if there is an advisor advising you and all. So I think there's a huge difference when it comes to investing for your long-term needs, because if you can save like even 0.5% on an annual basis by investing into an equity or a global portfolio, through an ETF or a passive building block, and that can lead to kind of great returns and also like savings in terms of fees, which translates into profits on your portfolio over the course of 10, 20 years, right? So I think it is important for us to understand that when it comes to long-term investing, why should you be paying that 1.5%, 2% to the unit trust? Is the unit trust really generating you extra returns? If not, you should really question why are you investing into them. And typically over a longer duration, it has been proven that over 90% of unit trusts, they underperform their respective benchmarks. So again, the point being, invest in a passive manner, invest and get market returns, but maybe have faith in the allocation strategy, because most of the returns that are generated is actually through the allocation process. And this is where the core portfolios kind of should shine through over a longer period, because we use our own proprietary strategy to kind of construct these portfolios. They're broadly passive, but we layer some of the smart beta factors that can lead to risk-adjusted returns over the long term as well. All right. I think another quick question, is there a chart where I can see performance of equity 100 portfolio in a more regular basis over the years? I think there is a chart on our website. So if you go onto the equity 100 landing page, and then there is a portfolio details tab over there, you can click on past returns. And then there is a full chart that is available for you to compare equity 100's portfolios return over time. If you are still not able to get your answer in the way that you want, I guess you can just reach out to our advisory team and we would be happy to help. There is a tab within our website as well where you can schedule a call with our advisors and they'll be happy to walk you through the portfolios too. Any crypto-based offerings in the future? Not yet, I would say. We do have some sort of crypto exposure that people are able to take via our platform, but you need to be an accredited investor for that. But if you're looking at ETFs, yes, we should be able to give you those kind of accesses. We are still kind of thinking through how to give exposure to crypto in a more responsible manner, because obviously last couple of years, the crypto market has gone through a pretty hard sort of a landing situation. I don't know whether it has landed yet, by the way, but looks a bit more positive coming into 2023 too. Plus the fact that there is now a lot of questioning around, who are the custodians? Is my money safe when I invest into crypto? All of these questions have now come into, a fore with the kind of situations that have unfolded with the likes of FTX and other, such firms as well. So we are right now a bit more circumspect in this sort of a direction. But yes, we are spending time in evaluating and seeing how best we can offer crypto as we evolve. There's a question from Steve. For Syfe REIT Plus, understand rebalancing is done 2 times a year. In the event that there is a rights issue, or if there is an unexpected negative event with one of the majority REITs, what will be the actions of Syfe? Will there be an emergency rebalancing to protect Syfe customers? So look, I think we generally track the index when it comes to our REIT portfolio, and we rebalance according to the rebalancing aspects of the index. For the rights issues, we will look at the fully diluted value of the REITs post the issuance of the rights issue, and then see whether it is in favor of the client or in favor of the investors or not. If yes, then we will subscribe to the rights issue. If not, then we will not. So yes, and if there is an emergency situation with a particular REIT, then yes, we do reserve the right to kind of do emergency rebalance in the interest of our clients. Yes. Cool. I think a couple more questions and then we will hopefully wrap up. Would you rather invest into an ETF like VTI, which covers a big part of the market, which has lower fees compared to equity 100, which we have to pay expense ratio in addition to Syfe fees? I think this is a great question. I think, in general, there has been a lot of debate. And now with our platform, essentially, you have the choice, right? Melvin, if you could go to the previous slide, you can go onto our Syfe trade platform, by the way, and invest into ETFs and just pay brokerage fee. And by the way, there are 2 free trades that you get every month. So if you want to, reduce your costs and all, you can definitely invest into a broad-based ETF by yourself and, basically don't pay any fees to us. I think the real value that comes with our kind of platform and the way we invest into the global markets and the kind of fees that we charge for it. So really what you need to basically map out is the, say, 0.5% fee that you pay to Syfe. Is Syfe bringing me enough value to justify that fee, right? Now, I would say the following arguments in terms of why that 0.5% is justified, or potentially we are bringing you even more value than 0.5%. So the few factors that I would highlight is, number one, the investment process, right? You can invest into VTI and you can get, broad-based exposure. But by the way, it will be a market exposure. And as I said, which is not bad, we should be getting market exposure for your long-term investing needs. Passive in nature, that's great. But it is market cap weighted in terms of how the returns, come out over the long term. In our case, what we do is essentially we invest in a passive manner to begin with, but we use systematic factors to enhance the returns of your portfolio. So it does not mean that we are trying to time the market. These are factors that have been researched over decades, and they are, they have been discovered to be factors that lead to outperformance in the long term. So we are talking about factors, right, in the sense that investing into growth stocks versus value stocks, investing into small cap stocks versus large cap stocks, investing into emerging markets versus the US market, reducing the overall volatility of your portfolio, riding on the momentum of certain stocks and all. These are all factors that have been proven by research in a statistically significant manner to kind of enhance the returns of your portfolio. So that's one aspect. I'm not saying we will generate alpha for you, but over the long term, Melvin, if you could go to the next slide, if you look at the 8-year annualized return for our equity 100 portfolio and compare it against MSCI World, the 8-year annualized return is roughly 1.2% higher, right? So, or 2.2% higher, something like that, right? So essentially you are looking at some sort of an outperformance there. So I'm not saying this is alpha, but this is systematically harvesting returns for the long term. This is one part of it, though. On top of it, we invest your portfolio in an efficient manner, right? Like, you don't need to worry about any brokerage fee, because when you invest into even a VTI, you do need to incur brokerage fee whenever you buy, sell, rebalance. Dividends are automatically reinvested. You can transfer between portfolios without any fees. Our advisory team is available for you to seek guidance at any point of time. So these are all extra features that you're getting for no kind of like extra cost. So these are all kind of all-inclusive 0.5% management fee. And for that, basically, you get all of these additional comfort with your investment. You can dollar cost average into these portfolios. You can invest in this globally diversified manner without having to worry about minimum investment commitments and stuff like that as well, which are relevant when you're trading on a brokerage platform, because there are minimum fees to be paid and all as well. So I think overall, I would say that if you think about the 0.5% that we charge versus the value that you extract from the platform, I think that you should hopefully, it should make it worth it. Cool. Just the last two questions. Will Syfe be able to accommodate or consolidate our different portfolios and display various stats? This is a great suggestion, and we'll definitely take note of it. So essentially the question is, now there are multiple portfolios, and if there is a way for an investor to see the overall geographical distribution, percentage of stocks, bonds, and other asset classes into the portfolio, kind of like an overarching view of all your investments. Definitely a great suggestion, and we'll keep it in mind, Sean. Last question, are there any plans to allow CPF investing for Syfe, or option for our Syfe wealth holdings to be placed in CDP instead of custodian? Right now, I think we are still very much focused on making sure that you're investing your cash very efficiently. There is still a lot of cash that investors have in their bank accounts not invested. So we are still trying to sort of solve the bigger problem. But yes, CPF investing is on our roadmap. I don't think it is immediate, but yes, you can look forward to CPF investing with Syfe over the course of the next couple of years. All right, I think that's kind of wraps up all the questions that we had. I think, Melvin, if you could show the last slide. Thanks everyone for being patient through the session. If you're a new investor, there is a promo code for you to get 3 months of fee waiver of your investments, as well as if you're an existing user, there is a fee waiver for top-ups too. So thanks everyone for joining in. Wish you all an advanced Chinese New Year. Have a great one, and look forward to connecting again in the weeks to come.